Maybe you've heard something about dividend investing, but how big can the effect really be? Well, the strategy of dividend investing has a large compounding effect. Let's take an example. Say you invested $10,000 in a dividend-paying stock that yields 2% annually and reinvested the dividends by buying more shares. Assuming an average annual growth of 7%, after 30 years, your original investment of $10,000 would have grown to a value of around $165,000. That's more than 16 times your original investment. Later in this video, I will expand this example, so stay tuned. In this video, I will show you why you should reinvest your dividends instead of taking the profits you make. This principle lets everyday people become millionaires and build wealth that keeps growing over decades even when you stop investing. According to Einstein, the strongest force in the universe is compounding interest. Who understands it, earns it. Who doesn't, pays it. As a young investor, it's important to understand the potential benefits of investing for the long term, and reinvesting your dividends can be a key factor in achieving this. Dividends are a portion of a company's earnings that are distributed to its shareholders as cash or additional shares. These payments can be made on a quarterly, semi-annual, or annual basis. The concept of dividend reinvesting is simple. It means taking the dividends earned from your investments and using them to buy more shares of the same stock or another stock. This may not seem like a big deal initially, but over time, the power of compounding can really add up. This is also called the compounding effect of dividend reinvesting. This creates exponential growth, as the investment will generate earnings from its original investments as all the accumulated earnings that you receive over the years. I share this because a lot of investors are frustrated by a lack of early results or even losses. How about when you don't reinvest your dividend? Don't you keep more cash? Nope, that's wrong. Assuming the same 7% annual return, your $10,000 investment would only grow to around $77,000 after 30 years. That's a significant difference of $60,000 in potential earnings. By buying more shares, you increase the number of payouts, which can be used to buy more shares. This effect is called the snowball effect, which can have exponential effects on the final outcome. Imagine that your horizon is even longer than 35 years. And even if you stop to reinvest at one time, the payouts will continue. This goes to show that the power of reinvesting your dividends really pays off in the long run. By reinvesting your dividends, you are not only earning additional income, but you are also increasing your stake in the company. Let's go back to that example from the beginning. Let's expand this example by including that you not only invest once $10,000 at the start, but also invest $250 monthly. In 30 years, you have invested $100,000. With reinvesting dividends, we have around $600,000, but without reinvesting, only $400,000, more than 50% additional growth. The best thing is, the longer you do this, and the higher the monthly investments, the bigger the snowball will be. And the cherry on top, you don't have to do anything for it. Well, besides the monthly investments, that's some serious passive income. And well, you also have to include the $90K on received dividend with the method without reinvesting, but it is still way less than when you would have reinvested it. And don't forget, this example is just with an annual yield of 2%. Many stocks or exchange-traded funds, also called ETFs, provide a dividend yield of 3%. Let's explore what happens when we include 3% into this calculation. The differences will even become bigger and bigger, especially at the received dividends. After 30 years, you've received around $204,000 on dividends when reinvesting, and only $133,000 if you didn't. To keep in mind, you only invested $100,000 over the total duration. So with only the profits of dividends, you have played break-even. But with the growth of the stocks, the value increased to $600K. Still not convinced? Let's explore some other benefits. Dividend investing offers several advantages for investors seeking both income and long-term growth. Firstly, dividends provide a consistent stream of income, making them attractive for those looking for regular cash flow from their investments. This income can be particularly valuable during periods of market volatility when capital gains may be uncertain. Additionally, dividend-paying stocks tend to be more stable and less volatile compared to non-dividend paying stocks. Companies that consistently pay dividends often have solid financial health and a history of profitability, which can mitigate some of the risks associated with investing in the stock market. Furthermore, reinvesting dividends through dividend reinvestment plans can accelerate the growth of an investment portfolio over time. By automatically reinvesting dividends to purchase additional shares, investors can benefit from compounding returns, allowing their investment to grow exponentially. Moreover, dividends can act as a hedge against inflation, since companies typically increase their dividend payouts over time, keeping pace with or even outpacing inflation rates. This can help preserve the purchasing power of investors' income streams. Overall, dividend investing offers a compelling combination of income, stability, growth potential, and inflation protection, making it a popular strategy for investors seeking to build wealth over the long term. Now that you understand the benefits, let's discuss the steps to start dividend investing. Start by researching companies with a track record of consistent dividend payments. Look for companies that have a history of increasing their dividends over time, known as dividend growth stocks. Then, assess the financial health of the companies you're considering. Look at key financial ratios, such as the dividend yield, payout ratio, and debt levels. A healthy balance sheet is crucial for sustainable dividend payments. To continue, create a diversified portfolio by investing in different sectors and industries. This diversification reduces the risk associated with individual stocks and ensures a more balanced investment approach. And then, consider reinvesting your dividends through a dividend reinvestment plan or by manually purchasing additional shares. Reinvesting dividends allows you to compound your returns and acquire more shares over time, as shown in the example at the start of the video. It's important to remember that dividend investing is a long-term strategy. Patience is key here. Here are a few points to keep in mind. While dividends are attractive, don't overlook the potential for capital appreciation. Look for companies that offer a balance between dividend payments and growth prospects. Stock prices and dividend yields can fluctuate in response to market conditions. Use market downturns as an opportunity to accumulate quality dividend stocks at potentially lower prices. Did you know that there are ETFs that include a wide variety of companies with great dividend yields spread over different industries, currencies, and continents? This decreases your chance to be affected by market fluctuations drastically. Don't forget to periodically review your portfolio and make necessary adjustments. As your financial situation and investment goals evolve, ensure your dividend investments align with your changing needs. In conclusion, especially young investors should really consider the power of dividend reinvestment as a key strategy to achieve long-term financial goals. The earlier you start, the better off you'll be in the future. If you want to know more about how to start investing, check my other video about 8 things you need to know before starting your investment journey. So that's it for today. We hope you found this information valuable. If you have any questions or topics you'd like us to cover, let us know in the comments below. Don't forget to subscribe to our channel for more insightful content on investing for young individuals. Until next time, happy investing!